Now, as you can see, this is a bearish bar. I'm actually waiting to see if a bearish bar forms. This is a bullish bar. I think I might have said bearish. But anyway, this is a bearish bar right now. The close is greater than the open. It is coming back to test this area. And so far, it has failed to actually break through and maintain anything above it. Now, the one thing that you do need to know is that although this stochastics is overbought, again, the 30-minute is not. This was moving up. Now, it may get into overbought status because now the stochastics has moved higher. So I'm waiting to see what happens here. Price has been moving extremely slow. You probably cannot tell it from this. It looks like big bars, but if you go down to, for example, a 5-minute, you can see that within, 4 bars, which is a 20-minute period, you're only moving from about 26 to 29. That's 3 pips. I mean, really a slow period this morning. Now, Nadex does make it very easy for you to switch the time frames. You can go from a 5 to a 15 with just a single click, or even to a 30-minute. I do use multi-charts, and because I trade usually anywhere between 8 to 10 currencies at a time. This is the multi-chart screen. And you can see this stochastics is not overbought. It is a slower stochastics. It's moving off the 30-minute. But we see this white dot up here at 111.36. That's where I'm expecting it to stop. I'm going to pin that there so we don't lose it. This is really where I would like to see that reversal bar come in. And this is important to really have that reversal bar. You don't just want one indication that it has found a resistance area. You actually want two. So the stochastics being overextended is one. You can see that the directional volume indicator is indicating that prices, that sellers are actually controlling the bar. But again, you need that reversal bar. Now, a lot of times on these, I actually go down to a 5 minute to look for the reversal bar. And you'll also have like trend divergence would be one that you could potentially wait on. It's been a very slow morning. You can actually tell it's been slow because you can see how small these price bars are. That's a good indication you've got a slow moving market. I'm really looking to see if this white dot holds price back. And as you can see, it did hold. Now you can wait, but if you do, you're going to pay more in risk. We have 111.38 on the 30 minute. We have 111.36 on the 15 minute that's potentially holding price back. We also have both the 5 and the 15 minute right now overextended. I'm actually going to use the 111.34 for the 7 a.m. expiration, which is only 45 minutes remaining. Now, on a 5 minute, that's pretty substantial. Again, it's flirting with it. It still has not been able to break it. And you can see I'm in demo so that you can see this trade example. Still no indications that you're getting a reversal bar yet. Now, when you're thinking about using an at the money or an out of the money binary, one of the most important things is, does price have the capability of achieving your at the money or your out of the money? Which one is more likely? And in this case, you can see that right now price is moving up. So let's say that we would want to go short. Okay, how likely is it that it will be below 111.42, for example? Or how likely is it to be below 111.38? Now, again, this is because the stochastics is overextended on both the 5 and 15-minute chart. So if you say, okay, well, I think it has a potential to be below 111.42, right now you're going to pay right about $53 in risk for that. Or you can come down one strike to 38. The problem with going down one strike to 111.38 is you have about $35 of risk, but will price be able to achieve this? Now, there's using the 7 a.m. expiration, you have about 40 minutes. Okay, so 40 minutes is about 8 5-minute bars. To move one strike took 2 5-minute bars here. It also took 2 5-minute bars here. So you need at least 10 minutes for this to move. Okay, so that's one thing that I look at, and you can actually see when it's probably not going to. And I'm going to go ahead and enter the 111.38, hopefully to show you the difference here. Now you can see this is $38 of risk. Now I can get it for 35. Okay. Or you could come up here and this would be your at the money, which is your highest risk. It's got $54.50 of risk for only a profit of 45. And again, these are just examples of using an at the money versus an out of the money. The one thing you do want to pay attention to is if this starts moving in your direction, how fast does the premiums change? And what you would want to watch is how fast this number is changing, if it's going against you or if it's going in your direction. And there is a substantial difference in the way these move. I know a lot of people trade the 5-minute binaries, but as you can see in this example, I've made a 40-minute binary by using a 2-hour expiration, but just going down to the one that expires the quickest. Notice you're at the money is not losing as quickly as you're out of the money. These are things that a lot of people fail to realize. Now, here's one of the important things that I look at. Right now, you've lost about the same amount on both of these. A lot of traders with the at the money, this is where they're considering exiting, which is pretty much the same amount as you have lost on the out of the money binary. Now, is there any guarantee that this will come back down? I mean, this is a 6 pip move if you measure it from where price is currently at to where your strike is. It's about 6 pips. So the question becomes, can this move 6 pips in your direction? And if you're looking at this, remember this is a 5-minute chart. So we have approximately 6 bars remaining in this binary option. So if you go back and look at 6 bars, does it have the potential to move that much? Yes, it does. It doesn't mean that it will. It just means, yeah, it has the potential to do it. Would like to see this current price bar close under the low of the previous bar. That means it needs to close around 42, which is right at the money strike. Now, if this price bar closes under the low of this price bar, you'll have a 3-bar reversal. So for example, the low of this bar was 111.427. So far this is 111.424. So this formation, which is called a pivot high, normally is indicative that this price bar will actually move down. We'll have to wait and see. Price typically does whatever price wants to do. The previous bar really did not do anything. It's just what's considered an inside bar. If we go and look at the 30-minute, you can see that it is now overextended. And again, this is one that is fighting the higher time frame because the higher time frame was moving up. Even though this is curled over, you haven't seen a substantial down move. Normally, it's because it's going to develop trend divergence. Okay, as you can see, it went higher, but the stochastics is lower. That's what we refer to as trend divergence. This needs to be a bearish bar in order for that trend divergence to hold. Again, you can still see the trend divergence is here, but the issue is whether this can move 5 pips within the next 6 minutes. And if you look at these bars, you can see more than likely not, because price is slow. Doesn't mean it won't, just means more likely than not. Again, you need a bearish bar to confirm the divergence. You would need a really strong bar for this to close below the at the money. And remember, this was the at the money when we went in. I believe it was right on this bar. This was the out of the money. This is why I like using the smoother stochastics versus this one, because although the regular stochastics showed that the market was overextended over here, you can see this one has not went above 80, you did have two stochastics in your favor, which was the 5 and the 15, but you're fighting your higher time frame. And when you're counter trend trading, fighting the higher time frame is not a good idea unless it's indicating an overbought or oversold status. It also shows why sometimes the market will go against you and you're like, well, why did it do that? Well, typically it's because your higher time frame is going against you. I'm going to put this window back, but I want to show you the difference on these. This is typically what you would want to see. And in this case, the 15-minute, as this went back to test, you can see there was hidden divergence. So price is making lower highs. Well, get my drawing tools on here. Price is making lower highs. Stochastic's making higher highs on this one. And you had trend divergence over here on the 5-minute. So this was just about the same time the other one came in. And you can see this one was a better setup because even though you were going against your 30-minute stochastics, both stochastics on both the 5 and the 15 showed that more likely than not, price would go down. Whereas on this one, you just had overextended stochastics. You didn't really have a really good setup. Now, you could have went in at the money or out of the money, but to me, the out of the money would be easier as far as a risk tolerance level versus the at the money, which has the highest risk available. I hope you enjoyed the live video this morning. I'm going to try to do more of these as time permits. Sometimes I'll be using a demo. Sometimes I'll be using a live account. Anyone that would like to send me an email message with any questions, please feel free to. My email is gm@tradershelpdesk.com.